Alright, thank you, Ruth. Alright, my name's Alan Levine. I am co-manager of A Plus Shoes, and I will be continuing the presentation today. And first, we're going to be talking about stock prices. Your company's stock price is a function of earnings per share, return on equity, your credit rating, and also some other metrics too, but those are the main ones. Alright, so we did pretty well the first year. We made some pricing decisions that impacted us well, and then in year 12 we took a pretty big dip in our stock price, as well as year 13. So the main reason for the dip in year 12 is our earnings per share also dropped as well. And that was mostly due, what I think, to some pricing issues, which I'll touch on a little bit later. But basically, we were pricing our wholesale and internet too close. Year 13 was the year where we tried to do private label, and basically just strategized that unsuccessfully, which I'll also touch on a little bit later. But that's why our stock price was so low in year 13. So after that, we start trending a little bit higher, and year 16 to year 17, we have a really big jump. And I looked at some of the other teams, and most everybody else has a really big jump there. So I did some investigating, and I think it has something to do with the favorable exchange rates. Because I looked at our operating profit margin, and it actually jumps from 18.5 to 30.8 in the wholesale market and 26.3 to 33.5 in the internet market. So that impacted our earnings per share and stock price in a really good way. So yeah, we kind of continue that growth in year 18, and then we have a little bit of a decline in year 19 and 20. And what it looks like is a lot of teams also struggled there as well. So I think that has something to do with the unfavorable exchange rates as well. So yeah, that time our operating profit margin dropped from 27.6 to 20.7 in internet, and 26.8 to 16.8 in wholesale. So that made our earnings per share go down, which in turn made our stock price go down. Next thing I'm going to talk about is the image rating. Okay, so in the beginning we invested some money into corporate citizenship, to just mostly maintain our image rating. And we were also pretty excited to bid on celebrities, so we probably spent a little bit more than we should have. And those extra costs kind of affect your earnings per share, your return on equity, your net profit, all those important metrics, they affect them negatively. And something I noticed in year 12 was one of the years that we had the highest image rating. Coincidentally, that was also one of the years we had the lowest, it's actually the lowest earnings per share, return on equity, and stock price, except that disaster year that the private label failed. But other than that year is our lowest year with most of our metrics. So in about year 15 to year 16, you'll notice that our image rating takes a pretty big plummet. That's whenever we decide to stop funding corporate citizenship, and also we abandoned some celebrity contracts there along the way as well, because they were getting a little bit expensive. So basically, we still bid a little bit on celebrities, but we decided to bid a lower amount, and we basically stop our funding for corporate citizenship. So that's why you'll see our image rating go down. So what we did though, we increased our advertising expense in lieu of relying on celebrity appeal or image rating to boost sales. So we used advertising as our method. Alright, so next I'm going to talk a little bit about the global unit sales. Right off the bat, the first thing you notice, we didn't really try private label very much. year 11, and we actually tried in year 13 as well, although it doesn't reflect here. And I almost think year 11 is kind of an accident because we basically just left the same SQ rating and the same price as year 10. So I think we just neglected to change it. But anyway, in year 13, our internet and wholesale market share suffer because we devoted quite a bit of capacity to producing private label, and we did not successfully compete in the private label market at all because our pricing strategy and our SQ strategy was way off. We had a high SQ and a high price for private label, which the idea of private label is basically a bid war between the companies. So we didn't have the cheapest price or even close. Team D, the year that we tried to compete, we were producing $42 7-star shoes, and Team D, was producing 3-star for $23. So basically, Team D pretty much dominated the private label market. I think it's because they had a bit more capacity and their production costs were quite a bit cheaper. So we didn't really bother to do a whole lot of private label beyond that. I messed with it, but I wasn't able to, to even get close to Team D's price. So looking at our wholesale and internet, since we didn't really mess with private label too much, after that year 13 private label incident, we have some increases, and then we kind of have a decrease, like in year 16 and 17. And I think it has a lot to do with a fundamental pricing issue that we had. Our wholesale and internet price were too close to each other, and whenever, according to real life too, but whenever that happens, basically they're going to fight for market share, and it makes the market share go down since they're competing for market share. The manual, I actually suggested having your internet price 40% above your wholesale price, which I didn't read until quite a bit later. So we basically didn't use that strategy at all. So I think that's why our market share, our global unit sales suffered a little bit there. So let's see, going on, talking a little bit about global market share next. So you'll notice in year 11 to year 12 we have a pretty big drop, and I think that has something to do with that fundamental pricing issue that I was talking about earlier. Because in Latin America our wholesale price was 90 that year, and our internet price was 61. So I mean that's completely opposite. And so we kind of, after that little mishap, we fixed our strategy a little bit, minus the year 13 private label stuff. And we also have some more pricing issues whenever we take a drop in year 16 and year 17. In Europe and Africa specifically, our wholesale and internet price were just so close to each other, so they were just fighting for market share. So, like I said, I realized that a little bit later in the game, so that's why we start to trend a little bit more later on. So next we'll be talking about the lessons that we've learned through BSG. And the first thing we've learned, is that internet pricing should have been at least 40% above the wholesale pricing, because we don't want to compete, we don't want to fight for market share with ourselves. It doesn't make sense. We focused on paying off loans as quickly as possible to maintain a high credit rating that made it possible to expand when necessary. If you'll notice, we had the A+ credit rating most of the time, except for the year 13 private label. Lack of celebrity endorsements made our image rating low, but it didn't seem to affect net sales. We basically advertised, raised our advertising expense rather than going through celebrities or doing the corporate citizenship. And our company did better in wholesale and internet market. We opted not to compete with Team D because we didn't have capacity necessary to successfully compete in the private label market. They were just getting their price really, really low, and we just didn't have the capacity to compete with them. So congrats Team D. Well, thank you for listening to our presentation, and hope you have a good day.